Good evening, friends. In the first session, we have discussed about calculation of cost of equity in different scenarios. We have discussed about primary market, secondary market, and how the shares are issued and what conditions need to be satisfied. Okay, all those things we have discussed. We have discussed about how present price of the share is dependent upon future dividend and future price appreciation, and how cost of equity is calculated accordingly. All these things we have discussed. We have discussed about dividend capitalization model. We have discussed about EPS capitalization model for calculating the cost of equity. It is a revision session, so you must keep one thing in your mind. You must have prepared at least once before attending these sessions. These are very important sessions. I will touch each and every aspects of capital market while revising the syllabus. Now my dear friends, as I have already mentioned in different sessions कि CA का मतलब सिर्फ चार्टर्ड अकाउंटेंट नहीं है. CA का मतलब है one is conceptual and for A it is analytical. So you have to build conceptual and analytical skill to become a successful chartered accountant in future. In student life also you have to concentrate on that. That means you have to build your fundamentals or concepts, and simultaneously you have to develop your analytical skill to convert yourself into a knowledge resource or a successful chartered accountant. Now today I will concentrate on two topics. One is your dividend and growth model, and second is risk and return and how it impacts the cost of capital. Now my dear friends, let us first go to dividend growth model. Now there are two aspects. One is dividend, second is growth. Dividend means the part of the profit which is distributed among the shareholders of the company, and growth represents whatever is retained. One portion is distributed as dividend to the shareholders, and the second portion is retained by the company for future use in the business of the company. Now when a part of the profit is retained by the company, then obviously it is going to be utilized for the future development of the business. Now when it is utilized in the business, then obviously it is going to bring some cumulative return in future. Now at what rate that cumulative return is expected to come to the company, that rate at which the company will grow is known as the growth rate. So growth rate is dependent upon two factors. Okay, one is how much you are retaining, and two, how much return you are getting from those retention. वो retention से आप कितना return पा रहे हो. So G is equal to B multiplied by R, where B represents your retention ratio. Suppose you are retaining 40%, then B is 0.40, and if your return on equity is 12%, then it is 0.12. So growth is equal to B multiplied by R, that is 0.40 into 0.18, that is 4.8%. That is your growth rate. So growth rate is dependent upon two factors. One is retention and second is return on equity. Now what is return on equity? Return on equity means what return the company actually gets by investing the money in its own business. Now you need not be confused regarding what the shareholders are expecting. What the shareholders are expecting, that is cost of equity, K, that is represented by means of K, because that is the expectation of the shareholders that the company need to meet. Unless company meets the expectation of the shareholders, then there will be a sort of confusion in the mind of the shareholders, and shareholders may sell the shares of the company, and market price of the share will come down and market capitalization will come down. Now how the market price impact the wealth of the promoters of the business, that you know from the other Adani case. In the Adani case, what happened? Market price come down and he was the third largest richest person of the world. Now he came to around 35 or 36th position. Now he is also below 20th position. So you see, every company should maintain a strategic planning to keep intact the market price of the share. If the market price come down, there will be several consequences. There will be a halt in the sentiments of the shareholders that will impact the future prospect of the business. Now you sometime what the company do, company mortgage the shares in banks and get the loan. If the market price go down, then the bank will ask for some additional shares to be given as mortgage, to be given as security for keeping the amount of loan intact. Else the banks will ask to return some sort of money immediately because market price has gone down. So it is very, very important. Growth is dependent upon two factors, B multiplied by R, retention and return on equity. Return on equity means how much I am getting by investing in the business. Return on equity is calculated by different models. Okay, now return on equity may be the internal rate of return of the business. That means you will take into consideration last several years cash flow of the business, how much the company has invested. Now you find out the internal rate of the return of the business, and that will reflect the IRR, or the return on equity of the business. So that is the fact that you have to take into consideration. Now, if company is expected to get continuous growth over a period of time, then to the extent of growth rate, the cost of equity need to be deducted, because I am expecting 15% and the growth rate is 4%, then my cost of equity will be 11% as of now, because 15% minus 4% is equal to 11%. So if my adjusted cost of equity is K minus G, that is 11% at the instant case what I have discussed, then what will be the value of the share? Normally we say P0 is equal to D1 divided by K, that is the dividend capitalization model. P0 is equal to present price of the share, D1 is equal to dividend expected next year, and K is the cost of equity. Now if I am going to get continuous growth over a period of time, then the growth rate will be adjusted to the cost of equity, then it is K minus G. So the value of the share will become D1 divided by K minus G. Okay, so that is the dividend growth model. Now here you will ask me, sir, what is the value of the K? Then we have to make the calculation. If P0 is equal to D1 divided by K minus G, then P0 into K minus G is equal to D1. Okay, so K minus G is equal to D1 by P0. So K is equal to D1 by P0 plus G. That is the dividend growth model, and this model was developed by Gordon's. That is the reason why it is known as Gordon's growth model. Gordon's growth model. Now there is a question. You said the growth is dependent upon two factors. One is B, retention, and second is R, that is return on equity. Now, how much the company is retaining? How will you know in future how much the company will retain? There may be three circumstances. One, company is following constant dividend policy. That means company is giving dividend at the rate of 60% every year. Then obviously the retention ratio is 40%. But company is expected to pay dividend. That means dividend is already given. How much dividend the company is going to give, and from that you have to identify how much the company will retain, and that retention ratio need to be taken into consideration while calculating the growth rate. Okay, and company paid dividend, expected to pay dividend and paid dividend. If in question it is given कि company paid dividend at the rate of say 20%, 25%, then you have to find out how much the company will pay in the next year. If growth is 2%, 3%, 5%, whatever it may be. Therefore, D1 divided by K minus G, when you take into consideration for the purpose of determining the value of the share, you have to read the question carefully, what they have given relating to the dividend, whether it is dividend paid, dividend pays, and dividend is expected to pay. Okay, so dividend is expected, D1 already given, normally pays, that means it is the normal dividend company is paying, you have to apply the growth, and if company paid the dividend, that is it was last year dividend, and you have to find out the future dividend. These facts you have to take into consideration. You have to do little bit practice relating to this before going to the examination. So dividend growth model, very easy. Okay, dividend growth model में two formulas you have to remember. One is value per the share, it is P0, which is equal to D1 divided by K minus G. D1 is expected dividend next year, so it is D0 into 1 plus G divided by K minus G. Okay, now if someone asks what is the expected, what is the cost of equity, then you have to find out the K. K is equal to D1 by P0 plus G, D1 by P0 in the bracket plus G. Okay, so D1 is expected dividend. So expected dividend is equal to D0 into 1 plus G. That you have to take into consideration. So it is dividends growth model. my dear students, now it is your responsibility to solve some problems relating to valuation of share on the basis of one, dividend capitalization model, second, EPS capitalization model, third, Mudgillian and Miller, that is D1 plus P1 minus P0 divided by P0. Okay, and I already told you how the K is calculated from that and how the P0, present value per share, expected price of the share, is calculated from that. We have discussed last session. Okay, it is the present value of future expected dividend and present value of price changes. Okay, D1 plus P1 minus P0. Okay, this is the price changes plus expected dividend. On the basis of that, you have to find out the cost of the equity. Now we have discussed about the dividend growth model. These are the four important models so far as valuation of shares without taking into consideration the risk part. Now let us go to risk and return. Okay. Now what is risk? Let us recap. It is a recap class. It is a revision class. So I'm not going into details, but I am covering each and every aspects that you should cover before going to the examination. Now let me go to what? Risk and return. What is risk? Risk means it is what exposure the business is facing, okay, in the present scenario, in the present environment. So every business is exposed to certain type of uncertainties, and that uncertainties is related to risk, So whenever we are taking risk, suppose I do not take any risk, I invest in government bonds, I invest in postal securities, I invest in bank savings deposits, whatever it may be, I'm not taking any risk normally, so therefore my return is the risk-free rate of return. But when I start taking risk, I am expecting some additional premium over and above the risk-free return. So it is the normal sense that expected return from any investment is equal to risk-free return plus risk premium. How the risk premium is calculated? The risk premium is calculated on the basis of risk that you are taking. So one important model in this regard is what? Capital asset pricing model. That model you have to go through and you have to solve some problems relating to capital asset pricing model. According to capital asset pricing model, the cost of equity or expected return on any security is equal to RF plus beta multiplied by RM minus RF. Now what is beta? Beta is how the security is sensitive to the market. So sensitiveness of the security with regard to the market is determined, and the sensitiveness so calculated is known as the beta. So beta, obviously, how the security moves with regard to the move of the market. So you need to calculate the covariance between the security and the market, and you need to calculate the variance of the market. So beta is nothing but covariance between the security and the market per unit of variance of the market. So how the beta is calculated? Beta is equal to covariance between the security and the market. So it is rho into sigma I into sigma m divided by variance of the market, that is sigma m square. So beta is equal to rho. Rho means it is just like P, you know it, into sigma I. Sigma I matlab standard deviation of the security into sigma m, standard deviation of the market, divided by sigma m square, that is variance of the market. Okay, so covariance between the security and market, it represents how the security moves with regard to movement of the market. Okay, the simultaneous move of the security and the market, it is the covariance, divided by variance of the market, that is beta. That is beta. So rho into sigma I into sigma m divided by sigma m square. If I cancel sigma I in the numerator with sigma m square in the denominator, then it comes to rho into sigma I divided by sigma m. Okay, so this way we calculate the value of the beta. Clear? Sometimes we calculate beta by means of regression analysis. N summation xy minus summation x into summation y divided by n summation x square minus summation x whole square. Okay, where y represents return of the security and x represents return of the market. So what you have to do? You have to take several periods, several times into consideration. Okay, n represents the number of counts that you have taken, number of periods that you have taken into consideration. X represents return of the market. How the return of the market calculated? That means you take into consideration return the security give in the succeeding day minus market price of the security in the succeeding day minus market price of the security in the last day. Okay, divided by market price of the security in the last day. That is P1 minus P0 divided by P0. From that you get the return of the security. Okay, and similarly you find out what was the value of the Nifty in day 1 and what was the value of the Nifty in day 0. So value of the Nifty day 1 minus value of the Nifty day 0 divided by value of the Nifty day 0 is equal to return of the market. So you go on calculating for say 12, 13 or 14 days, trading days obviously, since beta is related to what? Market only. It represents the market risk. I will go to that again, theoretical I will cover speedily so that you can have a look on that also. So regression analysis के through में I am calculating beta by putting the regression analysis formula, that is n summation xy minus summation x into summation y divided by n summation x square minus summation x whole square. Okay, so x represents return of the market, y represents return of the security, and obviously n represents number of the count. So you have two formulas to calculate the beta that you have to remember, and you have to do some practice relating to those two formulas. One is on the basis of standard deviation. Okay, that is covariance between the security and the market divided by variance of the market. That is rho into sigma m divided by sigma m squared. So sigma m square cancelled, rho into sigma I divided by sigma m. That is the value of the beta. Now in regression analysis, you calculate the return of the security for several period of time. You calculate return of the market for several period of time. Now you make a regression between the security return and the market return. You put the regression formula, that is beta is equal to n summation xy minus summation x into summation y divided by n summation x square minus summation x whole square. It is the beta. Now, what is this beta? What are the different types of risk? Now, from theoretical point of view, you also revise it, because in most cases, what the students do mistake, though they are convenient with the problems, they are doing the problems, but they are not writing the theories properly in the examination. Remember, you always apply 2.5 or 3 multiplier while writing the theories in the examination. In examination, you are going to get somewhere around 20 to 25 marks theory. So while writing the theories, you have to be very much serious. When I say 2.5 or 3 multiplier, that means if it is a 4 marks theory, then you have to write at least 12 lines. 10 or 12 lines. Point 2. Your theoretical answer should be point wise. Try to give point wise answers rather than paragraph wise answer. Point wise answer. Try to focus on the focal points. जो भी points है, do not mix those points. And fourth is very very important. Suppose you have to draw a diagram. There are opportunities to draw a diagram, maybe a graph. Then do not lose that opportunity. Draw the diagram. It will not take much more time. Draw the diagram, and through the diagram you will present how analysis you are making relating to the particular theoretical question. This is very very important, students. Do not miss the theories. 20 marks agar theory hai, and if you know the answer properly, and if you write 4 or 5 focal points within 10 to 12 lines for all 4 marks questions, then obviously out of 20 you are going to get 18 marks. And out of the balance problems, 80 marks, if you are going to get 70%, then 56 plus this 15 to 18 marks, 70 is the minimum mark expected in the strategic financial management. But what do? You go on writing the problems, giving the solutions to the problems, and at the end, when the bell rings for the 5 minutes, then you start writing the theoretical answers. And what you are writing, if I give the answer to you, you are not in a position to read those answers. Then how the examiner will get? You just think of. So be serious about the theories. Write the theories thoroughly while writing the examination papers. So my dear friends, very serious about the theories. Now so far as risk and return, what theories that you should cover? Okay, risk and return. Okay, higher the risk, higher the return. That is, they are directly proportionately related to each other. Okay, that means if there is higher risk, then expectation of return will be more, and vice versa. What are the different types of risk? That then you have to read it. One is systematic risk, second is unsystematic risk. Systematic risk is the risk which systematically affects all the companies in the industries or all the business houses in the industries. Non-systematic risk is the risk which is unique to a particular company, that is, it is the risk associated with a particular business. So systematic risk is otherwise known as market risk, okay, but unsystematic risk is known as what? Internal risk or unique risk. Systematic risk is known as external risk because it is exposed by the market, by the environment, business environment, but unsystematic risk is unique and specific to the business, and that is the reason why it is known as the internal risk. There may be a question, distinguish between systematic risk and unsystematic risk. So you have to write down these 4 or 5 points. Some examples of systematic risk: suppose there is some bad news comes in the market relating to the repo rate or whatever it may be. It is going to affect all the companies in the industry. I do not have any control, so I am going to suffer. Similarly, suppose there is a continuous foreign exchange policy change by the government, then obviously that is going to affect all the companies. I do not have any control. But internal risk, it is the internal problem of the business. Suppose there is management lockout, there is labor strike, there is continuous production blockages, whatever it may be. In such scenario, you do not have any control. आपका वहां पर कुछ भी कंट्रोल नहीं, आपका वहां पे कंट्रोल है. That means you can put some sort of control. That means you can hear the problems of the laborers, you can have meetings with the laborers and you can solve their problems. आप उनका problem solve कर सकते हैं. Okay, so in such scenario you have the capability to reduce the internal risk, but since external risk are imposed by the external factors, you do not have any control over the external risk. So be serious. Okay, external risk cannot be controlled, so you have to face them and you have to find out the remedial measures. But internal risk is under control. Suppose one business is not doing well, what you can do? Suppose it has exhausted the life cycle, then obviously you have to diversify the business. So what is a diversification of risk? That is the point that you have to remember. Diversification of risk means internal risk, that is risk which is internal to the business. The product is not working well because new products have emerged in the market. You are facing stiff competition in the market. Okay, and your technology obsolescence is there, and new technology you have to invest lot of money and you do not have sufficient fund to invest. You need some more time to bring fund to the business. All these problems you are facing. In that scenario, with existing fund in your business, you can diversify your business. That means you can enter into new business, you can bring new product lines or whatever it may be. Okay, so by diversifying the business, that is the problems that you are facing in the existing business, you are controlling that problem. You are controlling that problem. That is known as diversification of risk or minimization of risk through diversification of business. So internal risk can be diversified, even if practically it cannot be diversified totally. The risk cannot be minimized, cannot be brought to zero level, but still to maximum extent we can bring that risk to the minimum level. But external risk, you do not have control. If you do not have control over any risk, then you have to identify the level of the risk and accordingly you have to take the steps. आपको steps लेना पड़ेगा. The external risk is measured by means of beta, and internal risk is measured by means of the difference between the total risk and the market risk or the external risk. Now the total risk of the business is measured by means of standard deviation or the variance of the business. So if we go to the risk and return line, you read it from the books because I'm just making a revision, so I'm just giving an idea ki what you will read from the books or the materials, whatever you have. Okay, so you go to the risk and return line and the straight line that is drawn. Okay, x-axis is risk, y-axis is return, and you are drawing the straight line representing the risk and return relationship. The equation of that line is y is equal to alpha plus beta x. Okay, y is equal to alpha plus beta x. Here y is equal to your return, that means return of the security, represented as the return of the security with regard to the risk. Y is equal to alpha plus beta x. Beta means the market risk, that means relation between the security and the market. X is premium between the market return and the security return. So by applying capital asset pricing model, we determine the formula of capital asset pricing model to be expected return of the security is equal to RF plus beta multiplied by RM minus RF. RM minus RF is equal to market risk premium. Remember, RM is equal to market return, RF is equal to risk rate of return. So RM minus RF is equal to market risk premium. When I multiply it with the beta. What is beta? Beta is the risk of the security vis-a-vis the market. When I make a relation between the securities return with the market return, I get the beta. So it is the beta of the security. So when I multiply beta of the security with RM minus RF, I am getting the risk premium of the security. So RF plus beta multiplied by RM minus RF represents the expected return from the security under the capital asset pricing model. But my dear friends, here you remember one thing. RF plus beta plus RF plus beta multiplied by RM minus RF, it represents expected return of the security assuming that there is one risk, that is the market risk. Point 1. Okay, and point 2, there is full diversification. Full diversification necessarily means, okay, there is no internal risk. कुछ भी internal risk नहीं है. Whatever risk are there, those risks are only market risk. Assumption, there is no internal risk within the business. Everything is reduced. Every internal risk is reduced by means of diversification. Okay, so this is all about capital asset pricing model. Now here we are making a regression between securities return and market return. What is market here? Market here means the market in which the security is listed, and the market return is represented. For example, if it is listed in Bombay Stock Exchange, it is Sensex, and if it is listed in National Stock Exchange, you can take as Nifty. आप निफ्टी को ले सकते हैं या फिर सेंसेक्स को भी ले सकते हैं. नाउ सेकंड थिंग इज दैट देयर इज अनदर मॉडल, आर्बिट्रेज प्राइसिंग मॉडल. Only we assume that whatever risks are there in the economy, all these risks are reflected in the National Stock Exchange or the Bombay Stock Exchange. Okay, so Sensex and Nifty we are taking as the parameter, and we assume that all types of risk, whether it is related to foreign exchange, whether it is related to GDP, whether it is related to inflation, all of them are reflected in the market. But when I consider all such factors separately, then I use the model. That model is known as arbitrage pricing model. So in arbitrage pricing model, I take into consideration each such factor which is going to affect my security. So I need to calculate beta for each such factors. So in arbitrage pricing model, expected return from the security is equal to RF plus beta 1 multiplied by RM minus RF plus beta 2 multiplied by RI minus RF, where RI is equal to inflation return. Okay, similarly I go on calculating GDP return minus RF. Okay, beta 3 multiplied by beta 3. So I take each such factors and I calculate the expected return of the security. So it is a multi-beta model where I find out beta with regard to each and every factor which is going to affect the return of the security. So here in arbitrage pricing model, I calculated the expected return of the security on the basis of one risk-free rate of return, and I calculated beta with regard to several economic factors which are going to affect the return of the security. Okay, so you have to be very much careful while calculating the expected return, and you have to take the appropriate model while calculating the expected return from the security. Okay, so here we are assuming that internal risk is equal to 0. Else we are assuming that company is fully diversified company, but practically it is not possible. So therefore we have to take into consideration some internal risk, and how that internal risk is going to affect the expected return of the security, that we'll discuss in the next session. Thank you. Have a good day. Do some practice on beta, capital asset pricing model, arbitrage pricing model, and associated risk. Thank you. Hope you will do well in these topics.